Hello, it's been a couple of weeks since our last video, and of course it's summertime, and generally over the summer we expect things to be a little bit quieter. Perhaps not the case over the last couple of weeks, but also probably fair to say not a huge amount of surprises coming through, whether you're looking domestically or indeed geopolitically. Domestically, got a new Prime Minister. It's fair to say that wasn't a big surprise. And the market response to that has been, fairly modest. We've had a bit of positivity out of the UK stock market over the last week or so. So that's welcome, particularly as global markets have been fairly flat. But it is fair to say it's very early days. So, we wouldn't want to read too much into that just yet. Geopolitically, also perhaps not a massive surprise to see a resumption of the conflict in the Middle East. It is, changing day by day, and the news flow does move around quite a lot. Essentially, what's happened in a sort of short sense is the oil's response to that has been to increase again. We spiked to over $100 a barrel in the last sort of week or so. That has started to pare back a little bit. We're now in the sort of 80, 90 kind of range. But I think overall, if you look at this conflict in the round, I think it's fair to say its propensity to surprises on the whole is diminishing. As with all these things, of course, the news flow around it in the short run can cause volatility, but it doesn't necessarily mean in the long run it'll have a significant market impact. The most likely short-term impact, of course, relates to inflation, and that's certainly something we've spoken about in previous videos. There hasn't been a huge amount of inflation coming through from this increase in oil price, but if it remains elevated and continues perhaps even to go higher, there is, of course, an increased risk of inflation coming through. In addition to that potential inflationary impulse that could come through from the elevated oil price, the other risk of it, of course, is it sort of dabs the brakes of the global economy and sort of pulls us away from a sort of modest growth environment to a less good one, or perhaps even worse than that. In terms of the inflationary picture, it's a sort of tricky wicket for central bankers, perhaps. Generally speaking, we've had quite a few central bank decisions in the last week or so, and generally speaking, the decision has been to do nothing. In fact, whether it be the ECB, the Bank of Japan, the Federal Reserve, and in fact, the Bank of England have all opted to do nothing. And on the Bank of England in particular, that's the fifth meeting in a row that the committee has kept rates on hold. Generally speaking, from a central bank perspective, it is a sort of wait and see mode, which is fairly logical. The Bank of England Governor, Andrew Bailey, made a comment in the week along the lines of, don't expect us to be edging towards hiking position, despite the fact there are sort of an increasing number of votes in the committee suggesting a hike is the right way to go. And that actually pared back quite substantially expectations around September rate hike in the UK. It's fair to say it's now not the expectation. So overall, I think there is a really a sort of a modestly calm environment for central banks and for monetary policy watchers. So global markets, relatively flat, relatively unexciting. You might sort of think that if just looking at the top level numbers, things are just sort of ticking along very nicely. But what that masks, and what's really sort of fascinating about the last sort of couple of months, is the scale of intra-market and intra-stock volatility. There is some significant dispersion coming in, but because some of these big moves are happening at the same time as sort of counteracting big moves elsewhere, you're not necessarily seeing it in the headline market performance, although, if you scratch the surface and go a layer deeper, you do see some pretty significant moves. Give you an example of that. The Korean stock market closed up, in double digits, 13 or so % up. But it's been down twice this week in pretty significant terms as well. I think Tuesday was a loss of around about 10% on the day for the entire index. Wednesday, I think around about 5%. So big moves there. The index overall is actually slightly down over the course of the week, but still up over the last 6 months. So, it's not sort of overarchingly negative picture for Korea, but I'm just giving you that as an example of the scale of moves we're seeing in some of these markets underneath the global stock market sort of overarching picture. So these market level moves are in some instances pretty significant, but even on a stock by stock basis, there are some really material moves going on that you may not necessarily pick up if you look at the index level. You only need to look as far as yesterday to get an example of that. Microsoft up 15% on the day, its biggest move since 2008, and the scale of that move is massive given the size of Microsoft's overall market capitalization. And in fact, it was that move on its own, the increase in the overall valuation of that business was essentially larger than almost any European business in terms of its total market capitalization. So the gain in Microsoft alone yesterday was bigger than almost every stock listed in Europe in isolation. So, just give you a flavor for the sorts of scale of moves we're getting, not only at the index level, but also on a stock by stock level too. What's really interesting about that, we've talked about index concentration, market concentration, and when the going's good, when you've got a sort of tailwind in markets, which we've had over the last few years, that level of concentration hasn't necessarily helped active managers, because you've got these massive businesses doing very well, sort of almost in lockstep. It's very difficult for active managers really to sort of find an angle, to find a niche to exploit. But what we've seen over the last few months is, because the dispersion is increasing, you're still getting these very big moves from very big businesses, but they're somewhat counteracting each other, or acting sort of opposing and offsetting ways. We're actually starting to see active managers really sort of find angles to exploit and niches to come through. So clearly, over any period like this, and it's a short-term period to reflect on manager performance, of course, it's not just a case of active underperforming passive almost sort of exclusively. Now you're seeing some do better and some obviously not necessarily doing so well. But really on aggregate, and really I suppose almost anecdotally, we are seeing active managers sort of rise up and show sort of a glimmer of outperformance compared to their passive equivalents in recent months. I suppose it's the defensiveness of lots of active managers compared to perhaps the sort of more naive approach of index concentration, some of the quality biases that a lot of active managers have too. That's really starting to sort of show up in the numbers over the short run. As you know, in the Lion Trust multi-asset team, we have a long-term perspective from our investment management approach. And certainly when it comes to manager selection, we believe it takes a long time for that to come to fruition. So I don't want to read too much into that, but it is reassuring in a sense as a sort of an exemplar of the value that active management can bring, whether it be in terms of performance and outperformance, or in terms of outright risk management, that you've had a period where it sort of does demonstrate that active managers can deliver either of those two characteristics. Overall, we remain sort of cautiously optimistic as we head into the second half of the year. Our outlook remains constructive, but I think it's fair to say we're aware of this sort of scale of volatility underneath the headline level. And ultimately, to our mind, it reminds us of the importance of diversification and I think exemplifies how many different ways we can achieve diversification in multi-asset portfolios. There's the obvious one between equities and fixed income, for example, but even within equities, regional selection, stylistic selection, manager selection, all of these different levers that we can pull, we believe are valuable tools in the long run for multi-asset investors to have in their toolbox. That's it from me. Have a good weekend when you get there, and we'll see you next time.